It's no secret that the US economy has been slowing down. A growing number of economists are predicting that a major collapse may be imminent. In a recent interview, Guggenheim's global CIO, Scott Minerd, stated that the cognitive dissonance in the stock market is stunning, as reflected by ever-rising prices and credit spreads. He expressed that this is not a buy-the-dip market, but a don't try to catch the falling knife market, as prices have actually been in a downward trend for weeks. The stock market implosion may have already begun. The global economy is slowing down already, and investors fear that this could culminate in the worst economic collapse in history. Before we begin, we know our viewers value privacy and security, and so do we. That's why we're grateful and proud to welcome Surfshark VPN as the sponsor for this video. Surfshark encrypts all your internet activity and masks your IP address so you can buy, sell, and trade with confidence that your data and identity are safe. We love the fact that, unlike most VPNs, a single Surfshark plan can secure all your devices simultaneously: desktops, laptops, even phones and tablets. We also love how easy it is to change your perceived location to anywhere in the world, unrestricted. So yes, if you find yourself in China, Surfshark can bypass their censorship by connecting you remotely and securely to a US server. You can even save money on flights, car rentals, and accommodations overseas. Want to learn more? How about an exclusive discount just for our viewers? Click the link in the description, or go to surfshark.deals/epiceconomist and use the promo code EPICEconomist. You'll get 83% off and 1 extra month of Surfshark free. The stock market has potential for even more downward movement, while the bond market is now seeing the lowest returns in history. The 10-year Treasury bonds return is hovering at 0.77%. Technical analysis shows that this decline may continue to spiral to as low as 0.25% return, while 30-year bonds are expected to plummet to about 1%. At the same time, Treasury yields are already at historic lows, and credit spreads are remaining relatively tight. Fundamentally, this drop indicates that there will be more defaults by energy, airline, and hospitality companies. Nevertheless, central bank liquidity continues to flow into the bond market at a record rate. This liquidity flow from the central bank is what keeps the spreads tight. As long as the Federal Reserve keeps on pumping more cash, credit spreads will remain tight. Because of this, investors are having far more difficulty finding assets with a good return. There's an old Chinese expression that sounds like a blessing but is in fact intended as a curse. May you live in interesting times. All in all, these are certainly proving to be interesting times. Going into February, many experts were concerned that the Federal Reserve, by purchasing $60 billion in Treasury bills per month, was lifting asset values across the board in the fourth quarter and into the first. This form of quantitative easing has caused what is called the everything bubble, as virtually every sector was up over the past year, even when the overall economy was not doing that well. It is now quite clear that this bubble has begun to burst. The economy has already taken an unpredictable path, and many indicators are showing that we may soon find ourselves in the midst of an economic collapse. We have already reached the tipping point, and if no immediate action is taken, the stock market will continue plummeting. At the moment, the S&P 500 has already shed more than 3,000 points, and the 10-year Treasury yield is already at its lowest point yet. The Federal Reserve continues to pump billions more into the markets. This strategy is helping in the short term, but when you look at the long-term picture, the economy is very much headed in the wrong direction. Recently, we have also seen the central bank intervening in the repo markets to ensure that the market remains liquid. They have already pumped over $62.5 billion, with a lot more stimulus likely to be added by the end of the year. This intervention signals that things are not well with the financial system, and the Federal Reserve is afraid that a liquidity problem could bring the whole financial system down overnight. Indeed, a shock to the system like that could easily cause the most disastrous financial crisis in history. The US has one of the highest debt amounts in the world. As of this year, the federal budget deficit is over $1 trillion. Contrary to this, government spending is still rising, and Congress seems unprepared and unwilling to reduce this spending. Perhaps because we are in an election year, and this will reduce Trump's chances of re-election. For many years, this impending crisis seems to have gone largely unnoticed by the government. Instead, they have been proposing more and more federal spending. This action by the government is only making the bubble in the American economy bigger every day. The stock market is now at record lows, and all major stock indexes like the S&P 500, Dow, and NASDAQ are dropping in value every day. In the process, billions of dollars are evaporating. This might end up being a worse stock market collapse than the one we had in 2008. Gloomy economic data is being released every single day, and industrial production data is dropping at an alarming rate. This signals a major economic slowdown. As a result, economists have been forced to lower their expectations on the GDP growth in the first quarter. It is very clear that the US economy has been steadily weakening, and yet, contrary to expectations, the stock market kept on rising. This contrast all but proves that the stock market is in a bubble, sustained by continuous pumping of money by the Federal Reserve. Obviously, this artificial stimulus can't continue forever, and in fact, the effect may already be reversing to a point that's beyond our control. As the value of US stocks continue to drop in nearly every trading session, the mother of all stock market bubbles may already be bursting. Just a few months ago, when the stock market was rising, President Donald Trump took a lion's share of the credit and saw this financial performance as a symbol of success for his presidency. Ironically, at the same time, the real economy was slowing down, and employment numbers were beginning to plummet. Most people did not realize that the stock market was going up due to the stimulus from the Federal Reserve and their various policies, like super low interest rates and quantitative easing. This was an artificial growth period, and it now appears that the Federal Reserve has run out of tools to sustain the bloated economy. The reality is slowly being revealed, and more people are catching on. Panic in Wall Street is growing, and the stock market closes lower every day. Investors haven't been this pessimistic since just before the 2008 financial crisis. The Federal Reserve is desperately trying to cut interest rates, but this will not help. Last week, they lowered the rate by 0.5%, and yet the market is still plummeting. What already happened back in 2008 during Obama's administration appears to be happening again. It would not be a surprise if we woke up one day to the realization that the stock market is down by 50%. Various initial public offerings, or IPOs, are also quite bloated at this point, especially those related to cannabis companies. The US dollar is experiencing a bubble of its own, as it has lost much of its value due to unregulated distribution of new money. It is easy to envision a future in which precious metals like gold regain their usefulness as currency. In our current system, unstable and unsound money is everywhere. In many ways, our complacent politicians are largely to blame for what is happening to the financial system. They've made a string of bad decisions that have placed the economy on the path to a collapse. Elected officials have abandoned the effective economic models that were laid out by our founding fathers and replaced them with quick fixes that jeopardize our long-term stability. Our leaders simply don't seem to understand the gravity of their decisions. We currently have the highest amount of debt in history, and our economy is already bloated. The collapse of the American economy has already begun, and the current drop in the stock market is only a small glimpse of where we are headed to. The stock market is expected to continue its downward trajectory. In the past few months, those who pay attention have been alarmed by how overbought the stock market has gotten. That kind of growth is simply unsustainable. The downturn has only just begun, and most economists are expecting the trend to continue. In the last 11 years, the market has grown more and more bloated, and most buyers in Wall Street have already shifted their outlook, with many expecting a bear market for the foreseeable future. Financial analysts have been warning of this bubble for some time now, and this time there may be no fixing it, even if the Federal Reserve attempts to cut interest rates further. Potentially the biggest economic meltdown in history has already begun. We're all aware of the 1929 stock market crash that triggered the Great Depression. The upcoming meltdown may very well put the economic turmoil of the Great Depression to shame. A massive amount of wealth could evaporate from the stock market as a result. The Federal Reserve has already cut interest rates, and the recent 0.5% cut has barely affected the markets, if at all. It's entirely possible that they'll attempt a 0% interest rate as a way of reviving the dying economy. But at that point, in all likelihood, it will be too late.